Okay, hopefully everyone can see my screen. Good morning, thank you. My name is Will Maris. I'm the Managing Director for the Caliber Companies. And our topic today is on generating income in qualified opportunity zone funds. Let me first tell you a little bit about Caliber. Caliber is a company located in Scottsdale, Arizona. We have a 13-year record of growth, and we have been focused on the middle market areas, working with accredited investors. We have about $500 million in assets under management. And if you add in debt, construction loans, new projects we're working on, we actually have about $1.5 billion in assets under management. Now, being headquartered in Arizona, we believe that the Southwest is one of the best locations in the country to develop real estate due to the continued population growth and the expected economic growth with really no slowdown in sight. We also focus on multi-asset classes within real estate, and we launched one of the first opportunity zones going back to 2018. So as far as opportunity zones, most financial professionals, savvy investors, they know that qualified opportunity zone investments are a great way to shelter taxes on both long-term and short-term gains. And it can be gains made from selling stocks or selling real estate or even selling a business. Opportunity zones in particular geographic areas have been designated that are economically distressed. Those are considered opportunity zones. And the opportunity funds help rehabilitate those regions while providing investors with certain tax advantage benefits. In fact, if held for 10 years, an investor can actually not owe any federal income taxes on fund appreciation. So as far as the investment strategy for Caliber and their opportunities zone fund, in addition to focusing on the Southwestern region, we also have work off of different asset classes such as multifamily, industrial, commercial. And commercial, that includes, we have medical, office, retail, and then we do have some hospitality as well. Let's look at an example of an investment held as a regular investment and then one as a QOZ investment. So in this case, we have an investor who has $1 million capital gain. And one of the great things about a QOZ investment is you don't have to roll the entire investment. You can just invest the actual gain itself. So in this example, we have $1 million gain. And after the investor who doesn't have a QOZ investment pays taxes on that gain, he has $720,000 working, whereas a QOZ investor has the full $1 million working. And that's really where the investment changes, in that over a 10-year period, and in this case, only an 8% return, which hopefully we would do higher than that in the real estate projects that we have. We believe that by having these taxes paid early and being able to defer them, if you look at this after-tax value, you have 1.3 million in a regular investment, and your QOZ investment has grown to 2.1 million. Then after paying taxes, you see that the total 10-year after-tax gain, again, same type of investment, an 8% return, the taxable investment ended up with 310,000, the QOZ investment with 900,000. It's a big enough difference, obviously, that it could be an opportunity that we may not see again in our generation. The key ingredients is you have to grow the value of the capital. If you invest in an opportunity zone that really just doesn't perform very well, you're losing about 80% of the tax incentive, because it's the focus of that gain over the 10 years that really provides that great tax advantage. We also believe diversification is key. Rather than some opportunity zones that have just one asset, one developer, and you're really betting that that developer can perform on that one asset, we think that a diversified pool can outperform a single asset on a risk-adjusted basis. And then, because it's a pool of assets, you can actually compound gains within the fund. If in year 3, 4, 5, 6, you have certain assets that have some opportunity to be sold at some great gains based on market timing, you can sell those assets and then replace them with new projects within 12 months. So it allows for a compounding of gains in an opportunity zone fund. And then lastly, it's how to maximize the exit. Rather than just getting to that 10-year period and automatically selling the portfolio, there's other things that can be done. You could bring the portfolio public or merge with a public entity, do an upreat to the public markets, or because of a diversified portfolio, you could sell certain assets sooner than others and wind the fund down as appropriate. Caliber is considered a middle market real estate company, which means we really play in that $5 to $50 million space in real estate projects. And the reason for that is anything under 5 million, it's pretty crowded. There's a lot of mom and pops and entrepreneurs and small companies that can find the assets to play in that space. And over 50 million, that's where the institutions start to come into play. In fact, most larger banks and investment firms won't even look at projects under 50 million. So that $5 to $50 million window, which makes up a good segment of real estate projects, is where we focus on. And we will continue to do that and focus on being a leader in that middle market space. Now, again, I talked earlier about the Southwest. Arizona, where we're located, has been our main focus. And there's a real reason for that. Not only is it our backyard and we understand it very well and we know all the different real estate developers and the projects going on and we're able to compete very well. But if you think about it, when opportunity zones first came about, it was not too long after the real estate correction of 2008. And Arizona was one of the hardest hit states in the country. And it took a long time for Arizona to recover. So when those opportunity zones, where each governor had to carve out where they felt the right opportunity zones were in each state, Arizona had a lot. And Arizona had some areas that now over time are actually the opposite. They are some of the hottest real estate markets in the state, and Arizona is one of the hottest growth markets in the country. So we got lucky being in Arizona, and the opportunity zones that we have, we feel are probably, if they were to zone those today, would never be considered a place that needs rehabilitation. In fact, they're places that we're seeing tremendous growth. And Caliber was able to find and acquire a lot of those properties in Arizona and in the surrounding areas. And how Caliber works is when we have an asset, we set it up as a single asset LLC that rolls into the holding company, and those are owned by the fund. The limited partners, the accredited investors, profit alongside with the fund. And on the left-hand side, Caliber not only acts as a general partner, charges a 1.5% management fee, but also is really a 360-degree company that provides the development, construction. We have asset management in-house and even real estate brokerage. Our track record over our 13 years in business is about a 19% internal rate of return. And we've acquired over 400 properties in that time. Since we were one of the first to be involved in QOZ, we have been very active at the government level. We work closely with the White House Opportunity Revitalization Council, which helped create the Opportunity Zone program. And that also went all the way down to the governors of the states that we work in and even the mayors of the cities that we have projects in. Both our president, Jen Schrader, and our CEO, Chris Loeffler, have become experts nationally in the QOZ space and are often on panels as experts. As far as the fund itself, I like this quote by the Chief Investment Officer of BlackRock, who believes that assets that are alternative assets are now essential and are becoming a core part of investors' portfolio, which is the area that we play in. And because of COVID-19, there are some of the best opportunities in over 10 years for investors. So we're in the right space, in the right market, at the right time. We believe some of the key ingredients to being a successful investor is you need to work with a company that has fund infrastructure. In this case, Caliber, with about 70 employees, is able to manage the operations, the accounting, the finance, the taxes, the reporting, make sure that there are no mistakes which can lead to penalties. You want to invest with a company that has a track record and access to deal flow. Again, being local boots on the ground, we find deals that aren't always listed in the marketplace. In some cases, we work for years with different owners of properties to slowly work towards acquiring real estate. And then it's execution. Can you demonstrate that you know not only how to source the deal, but you can actually develop the project and then manage those assets over the next 10 years? The assumptions, this is taxed as a partnership, so the investors do get a K-1. We expect the wind down to begin in 2030, so 9 years from now. And we're looking at the IRR to be 13%, not counting income distributions that should happen over the life of the portfolio as well. So let's talk about a few of the assets that are in the portfolio, because that's where it gets exciting. A fund is only as good as the assets and the people building and managing those assets. So our only hospitality asset currently in the fund is a DoubleTree by Hilton. It's located in downtown Tucson, Arizona. It is connected to the convention center in Tucson. The convention center in Tucson did a major renovation in 2019. And for whatever reason, the convention center never had a hotel connected to it. And it was always a problem for people attending the convention center to have to stay down the street. So the city actually negotiated with us in order for us to build a ground up hotel connected to the convention center. They gave us a land lease of $1,000 per year. The best timing was that we started construction about the time COVID started. And during COVID, this project was under construction. It's now finished and it opened just a couple months ago, and it has 175 rooms. And we all know as the pandemic starts to wane that conventions in person will become more and more popular again. We're already starting to see it. And we expect that this hotel will do very well. Now, we own the hotel in the fund, and the income that is driven off of these 175 rooms will allow for income to come into the fund. And that's an important aspect of this, in this case, buy and hold strategy. Another project we have is in Tempe, Arizona. Tempe is a submarket of Phoenix. It's where Arizona State University resides, one of the largest college campuses in the country. And it's in desperate need of housing. And parts of Tempe were zoned as opportunity zone, which again, looking at it today, you would never think that that could be an opportunity zone area. It has seen great revitalization, and there is great things happening in those areas. We were able to acquire some land, actually 3 different connected parcels, and we have built 39 townhome units. And rather than sell these townhomes individually and grab the gain we could, instead, these are townhomes that the fund owns and that we lease out to young professionals, graduate students and the like that live in the Tempe area. They're not only new and fresh and hip, they're also priced competitively. We expect them to be always a high level of lease ups. And currently, out of the 39 units, the first phase is done and rented, and the phases 2 and 3 are currently still under construction and coming online over the next months. So we love this project. And again, trying to generate income for the fund, which over time can be distributed to the investors. These are the type of projects that do that. We have an outside management company that manages the townhomes and the rentals for us, but we simply maintain the asset while collecting rent checks every month. We have a behavioral hospital, a psychiatric hospital as one of our assets. This is as you know, mental health is becoming more and more a problem in this country and around the world. and mental health hospitals are becoming more and more in demand. We found in Phoenix, located almost across the street from the largest hospital system in Phoenix, there was a boarded up assisted care facility that the building had been run down. It was in an opportunity zone. It was a perfect opportunity for Caliber to come in, do a major renovation. Part of the success of opportunity zone is that you put a lot of money into these projects to revitalize the area. So we took a dilapidated building and put millions into the renovation. And we worked with the Phoenix Medical Psychiatric Hospital, who is our tenant. And they signed a very long-term lease for us to build them a 96-bed hospital. And it is now open. It opened in September of 2020. The beds are full, and the hospital is doing so well that the owners of the hospital have asked us to look for 3 to 5 more similar buildings or areas that we can do the same thing, not only in Arizona, but in surrounding states. So this is one that we believe over the next 3 years will provide us an additional upwards of maybe $100 million of new real estate acquisitions that we can do working with the same behavioral health hospital. Very exciting. And again, since we do not have any we do not run the hospital or have anything to do with that side of it. We simply are a landlord and they are a tenant, and we collect income off of this project and will continue to do so over the next at least 10 years. Downtown Mesa. Mesa also a subset of Phoenix, next to Tempe. And downtown Mesa, the city of Mesa, was one of the hardest hit areas when the real estate correction happened in 2008. Mesa was extremely hard hit to the point where areas had boarded up buildings and companies that went out of business. We saw that over time, as the rest of Arizona was recovering and downtown Mesa started to see the first signs of recovery, we started to buy up everything we could. We probably own about half of the buildings on Main Street in downtown Mesa, the main historic street, the business street. And over time, we will be doing major renovation and adaptive reuses. Some of the buildings are old and need to be careful that we use, that we build them back to what their original look was, and we work with the Historical Society to do that. Others are more aggressive, newer builds that we are building, and we're bringing the local community and local businesses to be our tenants in those projects. Things like local breweries and that drive clients and customers. In addition, we got a little bit lucky in the fact that after we bought most of these buildings, Arizona State University in Tempe, sitting next door, they said that they're going to be building a new auxiliary campus right in downtown Mesa, blocks from all the buildings that we own, which will drive thousands and thousands of daily students to that campus and customers to the different buildings. Now, one thing we're also doing that's a little different is we are not just acting as a tenant in every example. In some cases, not only are we owner of the building, but we also may own a portion of the actual tenant as well and generate income from actual business operations as well in partnerships with different businesses that want to build their business in that downtown Mesa corridor. So very exciting project. This will take probably the next 3 or 4 years just to do the adaptive reuse and renovations. Some of the buildings are just now being completed. Others are just getting started. So it's a nice rolling project. The other nice thing about downtown Mesa is we're not leading the charge on the revitalization of the city. It's already happening. We just were able to buy these at such time that we were able to take these assets before that revitalization really took hold. And now we're all rowing in the same boat towards this great new revitalization with a lot of other owners and developers in the market as well. One last project to look at, just so you can see the diversity of our portfolio. This is Rancho Solano, a very high-end private school. It's Rancho Solano does everything from kindergarten through high school, and they need more campuses. And they asked us to build a new kindergarten through 8th grade primary education campus in Scottsdale, Arizona. Again, looking at it on a map, you'd say, how is this an opportunity zone? It's only because years ago, they were areas that we thought needed more revitalization, and now it's some of the hottest real estate there is. And it's a perfect location for the Rancho Solano school. They have signed a very long-term lease. They have a buyout agreement if they'd like to buy it at a significant profit to us. And it is new construction. We are just getting started on that in the next few months. And we think that this will again be a cash cow real estate project. Once it's built, the school has a great track record and reputation. It will run for years and years and generate income to the fund. As we talked about, I use the word revitalization quite a bit. Revitalization is key towards opportunity zone investing. You want to bring those areas up in terms of socioeconomic class. And we have actually used NES Financial, JTC, to actually follow and report the impact that we're making. So they have done impact reports that are available. Reach out to me if you'd like to see that report that shows the number of jobs we're creating in those areas. It shows the level of income that's rising in those areas. It shows the vibrancy and the money that's flowing into the areas based on the projects we're working on. And that is a great feel for not only our company and our investors, but for the community as a whole to see the revitalization that's taking place in some of these areas. Another thing that I really like about the way Caliber works is the professionals we work with. So first of all, the fund is set up in a very traditional manner. 1.5% management fee goes to the manager, Caliber. And after the investors receive their principal plus a 6% return, the waterfall is a pretty common 80-20, 80% to the investors, 20% to us on any investor that invests $1 million or more. And any investor that comes in at our minimum of $250,000 or more, that split is a 75-25. On top of that, we use some of the top attorneys in the country. The Arizona office of Snell and Wilmer has been known to be one of the strongest QOZ law firms. We have worked with them since our fund's inception, and they really guide us as to all the tax and legal issues as it relates to investing in opportunity zones. The fund is audited by Deloitte. And one thing that's not on here, but I think equally as important, is the fund is valued periodically. Every 6 months, typically, the fund is valued. So as new investors come in, they are coming in at the current value, being fair to those that invested earlier if the valuation adjusts upward. So how do you do those valuations fairly? Well, you go through a valuation process with appraisals and outside firms to value that. But then we use BDO to actually audit those valuations. So a very institutional type structure we use to run the fund. So the takeaways, we have some strategies that some investors don't always realize. Most people think of qualified opportunity zones as the tax advantage growth. How do I put my money in and over 10 years have tax advantage growth? But as part of this that we discussed today, we focus on providing income as well. So that fixed income component on our real estate projects is an important part of the fund. And it allows for investors to not just have to sit back and wait for the next 10 years before they see the return, that they actually get some income along the way. And then forgetting that these are even in opportunity zones, and the tax advantage part that plays a role here is we believe we have some amazing opportunistic growth. These are in areas that we believe will rise and create additional value over time. And of course, because of the renovations or the ground up development we're doing, we think we are providing great opportunistic growth with income and has the QOZ tax advantage as well. So really the trifecta of success if we do our job. And to do our job, we need a unified team. And our 70 employees here that has the breadth of really all aspects of being able to source and develop and manage real estate, is what we bring to the table. Our partners, the top tier service providers like BDO and Snell and Wilmer and Deloitte, I think also set us apart from other companies that work with smaller local professionals, and we want the very best. And then the last part I'll mention is Caliber's location. Because we are here in Scottsdale, Arizona, and it's our backyard, we're able to find and access deals in what we think is one of the hottest areas in the country, which is the Southwest. We are doing some projects in Colorado and other areas, and those will continue. We like markets like Denver and areas around in Nevada, like Las Vegas and others. So we'll be continuing to grow the fund. The fund currently is about $120 million and will grow to a maximum of $500 million. So we have plenty of room for growth over the next couple of years, and we expect that the fund will hit that $500 million here before too long. So with that, I thank you very much. If you have any questions, we have, I think, Victoria on the line that's going to read any questions that came in.
So Will, I'll be handling it. I know I'm not as nice as Victoria, but I will ask you a few that have come in.
Okay, thank you.
First, Rob Jaffick, one of our members, he wrote a very nice comment about you guys. He said he sold a building to you all. It was a fair price with a clean and easy process, and Caliber had the capacity to get the value add done to the asset that it needed. So
great
that was
to hear.
Great little testimonial from Rob. Okay,
Thank
so
you,
one of the questions, are there plans for a distribution in 2027 when the tax on the original gain is due? And how do you plan to redistribute those proceeds? Refinance, sale, etc.?
Great question. So yes, in tax year 2026, payable April of 2027, there are taxes due to investors in an opportunity zone fund. We have used very low leverage in our portfolio, under 50%, so that if we needed to generate a distribution, which we will be making, we expect to distribute about a 25% return of capital to the investors in late 2026, early 2027, in order for them to be able to have the capital to pay those taxes. We have not only this low leverage on our portfolio, which we can refinance certain projects with a little bit higher leverage to generate capital that can be used to send out. In addition, by, we believe, 2026, we may have some projects that market timing may necessitate where we feel it's the right time to sell and redeploy. And so as we sell, we will have the capital available for distributions as well. So that will be always on top of mind and something that we will inure to do at that time.
Okay, great. Got another one. Can assets be sold and the gains redeployed within the 10-year window?
Yes, they can. So if we sell an asset, we can turn around and use those proceeds to find another qualified opportunity zone project rather than distribute that capital out. I think that's a distinct advantage of having a multi-asset fund like Caliber's. It allows us to make decisions throughout the 10 years that we think are best for the fund and the investors.
How much have you raised since inception?
We are about 120 million in the fund. And as I mentioned, it caps out at 500 million.
Am I issued a K1 for this fund? And if so, should the depreciation negate most, if not all, of the income?
Good question. So yes, this is taxed as a partnership. You will receive a K1, and at times with any K1, as you know, that if income is earned but not sent out, that can be a phantom income distribution that taxes are owed. We typically try to make sure that there's depreciation and other losses in the portfolio that offset any of those potential income or gains that come into the fund. And if it's clear that there wasn't enough to offset, then we look at actually making a distribution to the investors to cover that income that was reported but not received.
Okay. Last question. What other markets outside of Phoenix is your fund targeting?
So we really like all sorts of areas in Arizona. It's a booming state, and we're looking at projects throughout the state. We also like the Denver market. We have acquired outside of the Opportunity Zone Fund some real estate and some projects going there. We're looking at some projects in Opportunity Zones there. As I mentioned, Nevada has some great areas and has a similar climate, business, weather climate to Arizona, and also feel that Nevada has some opportunities. And we'll look at some areas in Texas as well. We like Austin. We have a project in College Station that we're moving forward on. So we're staying within the Southwest, but not just entirely Arizona.
Great. Can you give everybody your contact one last time, and then we're going to hand this over to Ernest.
Great. Yes. Again, reach out. invest@caliberco.com goes right to myself and Victoria, who's on the line, and we can answer any additional questions that you have.
Thank you so much. Ernest, are you there?